Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on Wednesday, March 17th. What a fun day this is set up to be because, we have the Fed. I think they may have lost control of the bond market even before their whatever wild announcement they have planned for later today. God only knows how gold and silver will react, although to check in and discuss it all and give some guesses are Andrew Maguire of Kinesis Money, and he's brought Eric Main with him today as well. So, gentlemen, it's a pleasure to have you both on here, and how are you doing today?
Thanks, Chris. Happy St. Patrick's Day.
Yeah. Hey, Eric, I'll introduce you in a second. It is also such a privilege for me to bring Eric on, but great to be with you again, Chris.
Well, it's a pleasure to have you back. There has been no shortage of activity to keep the world busy since last time we've had you on. But why don't you introduce Eric first and let people know about his background, and we'll get him introduced, and then plenty to dig into.
Yeah, this should be quite insightful and very helpful, I think. And so, it's a great place to start. And so Eric is the current co-founder and chief strategy officer of Kinesis, and of course of the allocated bullion exchange, the ABX. So Eric brings actually more than 40 years of financial services. It makes me a bit feel like a very young person at this point, actually. But 40 years of financial services. He's got executive positions that are bringing to the table, which is over 15 years of physical bullion, with trading with the bullion banks in New York, as well as leadership positions with quite a few international exchange groups, including ICE, which we all know, Singapore Exchange. So I just wanted to say, I've had the privilege of getting to know Eric and working with him for over 10 years now. But I can tell you, I'll let him sort of speak a little bit about himself.
Thanks, Andy. I appreciate it, and thank you, Chris, for having me on. So yeah, I think the thing to take away from my inputs here is my 15 years with the bullion banks in New York, and I thought it would be useful for some of your audience to hear kind of firsthand of how the evolution of how the central banks and the bullion banks came together originally, and how they kind of then veered into a darker path. So we're talking the time frames we're talking about is the early 80s through into the mid 90s. Yeah. And at first it started out pretty innocently between the bullion banks and the central banks, actually. So at the time in the early 80s, the gold price is very range bound. It's not moving very much, but the interest rates are quite high. So the contango structure was quite robust. And the bullion banks, and it was J. Aron, the division of Goldman Sachs, that first got the central banks to write call options against their gold reserves. Out of the money call options for the central banks to earn some premium income. And maybe surprising to some is the first central bank that jumped in to do this was the Central Bank of Portugal. Now, Portugal had a huge amount of gold reserves compared to the size of its GDP, and that's went back hundreds of years from their colonial days, colonialization days. And based on their economy, they're looking to make some extra money on what obviously has been an asset that doesn't yield anything. And so they wrote these out of the money call options. They got some pretty good premium income because of the structure of the contango. And that was the first foray for bullion banks with the central banks. But then it morphed into something else. So now we're in the early.
And Erica, I'm sorry, that period you were describing, what year would you say that was?
In the early 80s.
Okay, so post Hunt Brothers.
Yes, post Hunt Brothers.
Okay.
So that the gold markets, they're just, and the derivative side and structuring financial products is relatively new, right? Because they came about after the freeing of the gold price in the mid 70s. And they're starting to replicate financial instruments that were, prevalent in the other asset classes, in the bonds and equities and even other commodity markets. And the darker turn that happened was really when the leasing came about. So now the bullion banks are growing their derivatives book. There's a lot more of their own trading books. Plus there's some pretty heavy at the time, long dated hedging going on. So the likes of American Barrick were doing forwards, selling production out 5 years, 10 years, even 15 years. And to support that in their derivatives book, the bullion banks didn't want to utilize their own capital for their derivatives book to support the hedging programs. And so they convinced the central banks to lease them the gold. Now the gold never moved, right? It's sitting at the Bank of England or it's sitting in the Fed, New York Fed, and the title of ownership from a lease structure moves over to the bullion bank. And what they would do is they'd sell the gold into the paper market, the London paper market, and use the cash to fund their derivatives book, to for the capital and the initial margins and so forth. And so then that's still fairly innocent because it's just between the central bank and the bullion bank. And the central banks would only deal with a handful of banks at that time. Only those that had AAA and then a little later on AA banks. So there's not many, although there's a whole cadre of other banks and brokerage firms underneath that were starting to build a precious metals business. So that was fairly innocent, but this is where it starts to get a little dicey. And that's where now we're in the mid to later 80s, where gold loans are a big deal for the mining firms. So, rather than just hedging out their production 10, 15 years and hoping that production will be fulfilled and that the banks can then take that production and, cross off the leases. Now they're going to want to expand their mining footprint. So they want to develop a new mine in South America or Africa or North America. And now we're talking big bucks, $50, $100 million at a time. And the banks, didn't want to use their own money, of course, to fund that. And the mining companies, look, we all know that mining companies, it's all about the share price, right? So they didn't want to float more equity for a new mine because that would dilute the shareholders. They didn't want to float new debt because that would look bad on the balance sheet. Again, the share price would suffer. So where do you go? Well, the banks aren't going to give them $100 million for a gold mine that's going to happen in 3 or 4 years down the road. But if they can lease the gold from the central banks, monetize the gold in the London paper market, take that cash and give that to the mining companies as a structured gold loan, then there's no sweat off the bullion banks. And they're happy to do that because there's big margins in those gold loans. Okay. So now you have a situation where there's a link in the daisy chain. You have the central bank to the bullion bank, and now the bullion bank monetizing that leased gold and then taking on a credit inference to the mining companies. And so it goes. And it got then even further down the daisy chain when now these middle tier mining companies are looking to do similar things, right? Junior mining companies and mid-level mining companies that the bullion banks, the big banks wouldn't touch credit wise. So there's all these second tier of banks, of whether it's at the time BNS, Bank of Nova Scotia, now Scotia Bank, or Merrill Lynch, some of the investment banks and brokerage firms. They had their own client bases where they're doing things with mining companies, and they were willing to take that credit on gold loans. So now you have another link. You have the central banks leasing to the bullion banks, the big guys, the JP Morgans, the Goldman Sachs, and a couple of the Swiss banks at the time. And you had those banks leasing again to the second tier banks. And the second tier banks then monetize the gold. They sell the gold into the paper market, they get the cash, and they give the gold loan to the lesser credit mining firms. So
Aron, one question as you're saying that, and I can't tell you how much I appreciate you bringing this up, because I've been hearing a lot of people talking about these short positions are hedges and they're leasing the metal. Can conceivably in that setup that you just addressed, it wouldn't even necessarily have to be gold or silver that was leased. They could really take any asset, lease it, and monetize it if the end goal is to provide a source of financing to go get new mining projects. Would that be correct?
Yeah, I guess so. But this is an easy asset to do because it links with the underlying product, right? So they're going to be able to hedge themselves and get their price exposure out of the way as well.
Right.
So it matches up kind of 1-to-1. But the game has now changed. So that was through the mid 90s. The game has changed somewhat now in that you're right. Now it's more about gold loans are out of favor because the interest rates and the contango structure is not as good. Long forward hedging is out the door. Gold loans are out the door. But so now what's gotten exponentially big are the derivative books. And so to finance your derivatives book, it takes a lot of capital, it takes a lot of margin and initial margin calls, et cetera. So this is where now leases can come into play. You monetize leases again and sell it into the paper market and then use that for your derivatives book. But now it doesn't have to be just for your gold book. You could use that very cheap capital because these lease rates are very, very small, and use that capital and monetize it and finance your bond book or your other commodities desk books. So it creates now that's where kind of where you're getting at, where there are some cross purposes where this can be utilized. But I guess the last point I'll make is that there used to be, because we're fast forwarding now to current day, it used to be that the central banks were the only place for this centralized pool of gold assets that could be used in this manner. Yeah. And now there's a second pool, and that pool is the gold that sits underneath the ETFs and how that could be utilized in a similar manner. But as I said, it's mostly now about doing internal financing, but it still flows down to second tier banks and away from the in a tiered basis. So for me, it's mostly about the ownership structure of the gold. I personally, I know there's a lot of opinions out there. Is the gold really there? And all that kind of thing. And my own personal opinion is the gold is there, but it's a question of who owns it and who has control of it and who's on the hook if something goes bad. Because if you go down this daisy chain of lesser credits, one link in that chain breaks, and it's going to affect a default situation that goes all the way up to the top. So.
Yeah, and well, I have several notes from what you just said. Let's start with, you just towards the end there mentioned that now they have access to the ETFs. Can you talk more about that, please?
Yeah, sure. So look, I'm not disparaging ETFs, gold and silver ETFs. They serve a useful purpose. And it's more about, it's just a different dynamic of who utilizes them and who finds value in utilizing them. So ETFs are very, I just want to start with this preface. They're very good for the institutional money managers, for instance, because they generally have a board mandate that they can only invest in securities, things that are securitized, have a regulatory framework around it. And that makes sense, right? Because all their other asset classes are the stocks and bonds, and this is a very easy touch for them to go into another asset class that's already a security. So many of them are board mandates, but they're not interested in the physical gold or silver. They're interested just in diversifying the price so that they get exposure to the price, and it's a non-correlating asset to their other baskets, and it's 2 or 3 or 5% of their portfolio anyway. So they're happy to do that from an institutional standpoint. So it makes sense for them. I guess the only thing I would caution is for people to do a deep dive into the prospectuses of the ETFs. And this goes again around control and ownership and reporting. So while there are custodians that sit underneath the ETFs, and first of all, for those that want to own physical, right? You own an ETF, you don't own the physical, right? We all know this. You own a share in a trust, and the trust owns the gold. And so if you're looking for something that gives you direct title to the underlying asset, then ETFs are not the way, because you're only getting a share in a trust. But beyond that, if you do the deep dive in the prospectuses, it's quite clear that, first of all, there's all kinds of disclaimers all over the place as far as their what they're able to cover and not cover. They have no sight really over over the custodians. They take the reports that the custodians give them on a periodic basis, and there's ways to do this. So when I mentioned these gold leases from the central banks or otherwise, generally, they're very short term in nature, 3 months, 6 months, never more than a year. And most of the times, never over a fiscal year end. So you would make sure that your books are squared. So when you put out your financial statements that are based on, if your end of year is December 31st, on December 31st, all the leases are cleared, and you can say in your financial statements, I have no leases on my books. Of course, first week of January comes, and you lease the metal, and then you start rolling those short-term leases, and you square them up at the end of the year. This is the kind of stuff that goes on so that you can say things like, I have no leases on our books. But but again, to dive into the prospectus is just a tiny bit. So it's about control, and the custodians, they have certain reporting requirements, but as you can find out, the custodians can utilize sub-custodians, and those sub-custodians can use sub-custodians, and down a different daisy chain. And there is no reporting requirements for those sub-custodians or sub-custodians. And that's where, and they're the same players. They're all the same players. It's not going to, out into the ether. These sub-custodians are the other banks, and whether it's first tier or second tier. And that's where the ability to utilize that gold is affected. So I would just suggest, take a deep dive into prospectus. You'll see that there's a lot of wiggle room in what can be done and not be done. And it's for me, it's about the control issue. If you don't really have control over the asset, which the trust admits, they really don't have control over what happens at the vault. They don't have control on reporting. They don't have control on what happens with sub-custodians. That leaves a lot of wide berth for the things that we're talking about to happen.
Yeah, I'd say so. And let's do a deep dive in right now if you have a couple minutes, because you talked about how it's like a chain, and if you have one link break, watch out. From everything I can see, it seems to me this chain broke February 2nd. And talking about the prospectus, I'm sure you're well aware of the changes that were inserted into the prospectus for SLV February 3rd, I believe it was, SIVR and some of the others, but right around that period, you're familiar with those, correct?
Yeah. Mm.
And I might add that I actually called iShares on February 5th, the Friday that week, because when SLV reported, and let's pull up their own data so there's no mystery here, because prior to the Silver Squeeze weekend, actually, and we'll pull that one up as well. Give me a moment so we can put this in context. And I'm just really happy you're here to answer some of these questions. Prior to that Silver Squeeze weekend, it looks like, aside from when the trusts were started, that about 20 million ounces was about the record. So this was back in January. Andrew, I think we talked about that on one of your appearances, because there was a 20 million ounce edition in one day. And I remember looking back and I'm thinking, all right, here's 6 months. That's the spike. It's still, before these three, the biggest one.
Yes.
2 years. It's still, I mean, that was a big one. Here's back 10 years. Maybe there's a bigger one in 2013 by a little. Here's the 20-year chart. And you can see 20 is close to the record. And then, so we get something pretty big in January. Then you have Silver Squeeze weekend. The Friday, you get 34 million, which blows away the previous record. Then Monday was, I think, 20 million. And then on Tuesday the 2nd, the day that the price came down 10%, you have basically 3 times what was the previous record if you ignored Friday. So a massive amount. I've also been asking bullion dealers to get numbers. February 2nd, you could conceivably say, was the single greatest day of silver demand in the history of planet Earth. The price came down 10%. They changed the prospectus the next day. And especially because what happened was when that 61 million number came in, I kept talking to all the people I bring on the show. No one could see how it was possible. So on the 5th, I actually called iShares and said, you know, is this mean, I thought, I don't know, maybe when they say those shares are added, maybe they're working the order or they're going to go get it. And she confirmed no. When shares are added, metal's added that day. I said, who does that? He says JP Morgan, the custodian. And I said, with all due respect, that's a little concerning given what they've been caught doing recently. She never mentioned. Now, I didn't know about the prospectus changes until the following week, but on February 5th, she didn't say anything about that. Jeff Curry didn't say anything about it of Goldman Sachs on February 2nd on Bloomberg or February 4th on CNBC. And Eric, you mentioned the ability to stack dates creatively if someone wants to avoid things. I was 40 minutes in asking him, like, is there an audit? Because I couldn't find it. This is what she sends me. The last time anyone aside from JP Morgan has put their name on those trusts, it's March 20th. I'm like, wait a second, March 20th. I'm like, that was right before the EFP market broke on the 23rd.
Yeah.
And I'm not saying this is the case, but at least the next thought that popped into my head from my time on Wall Street, where I ran an equity options specialist post, I remember, like, if you had bad news, they put it out on Friday, hoping people would forget it by Monday. And I'm thinking, is March 20th a Friday? Sure enough, it is. And then here you have these dates. The date the audit was actually finished is March 6th. And then if you look here, 11 days later, silver is below $12 on March 17th. And as it's falling, this is the SLV data. We look at March. So as the price is falling below $12, SLV adds 13 million shares. And how about I stop there? I know I threw a bunch out, but I'd love to hear your comment on any of what's happened on that week.
Yeah, I'll let Andy. Andy, you want to take that one?
Yeah, I mean, I think we kind of did discuss this last time, Chris. I mean, look, what we're saying really is, you know, this SLV has an entangled relationship with the very same insiders positioning in the COMEX and the over-the-counter market. So what it does is provide a flywheel to rehypothecate physical silver sitting on their books. And essentially, that's kind of what Eric was saying. And look, this has historically protected them from having to sell physical silver inventories into the trust at prices which are clearly far below what real supply-demand fundamentals dictate. That is the thing that blows people's minds consistently, is how can you have this inflow of physical bullion? And let me just add, we kind of went through this once before. Logistically, it's actually impossible to count that many, even if you've got 5 vaults spread around New York and London, it is impossible to account in, weigh, and weigh these number of bars. So look, any wholesaler and any of your wholesaler friends that you bring on, they're going to tell you the same thing. Look, there's no way that this physical can be possibly physically moved into that vault. It has to exist somewhere in a vault and kind of shove a warrant over, or it's got to be leased into the trust so that the trust can square the books. But this March 20 report that you showed was the last time there's also been any audit on the SLV. And of course, what happened after March the 20th? We had a massive rise in the price of gold. So it was the bottom. It was the EFP blow up. So what did they say? They said the bars exist. And this is kind of what Eric's saying too. Yeah, the bars exist. You can count them and they exist. But how many ownership claims are there? How many times is each bar rehypothecated? So it is a major concern. And I like Eric, don't view SLV, for example, or an ETF like that as any form of ownership of physical.
And Eric, I guess maybe a follow-up to that. I mentioned how I've been reading this book about what actually happened in the 80s with the CFTC. I mean, they described the same thing that's happening now, although this was before, 30 trillion of publicly stated debt. By the way, did you guys know Dr. Mark Skidmore, who had found $21 trillion of missing money from the Pentagon and housing and urban development? He's now up to 145 trillion.
Wow. No, I didn't hear that.
No, didn't know.
And now we hear Jeff Christian has said there's no chance of the COMEX blowing up because they can cash settle, which seems to me a matter of semantics. Yet I don't expect banks or government to ever do anything because they're going to grow a conscience. But it seems to me like, especially when you look at how they've reacted, I think the reason we've never heard of Jeff Curry before, that was damage control. Like when you're not desperate to throw that guy out there on TV to lie his face off. So, I mean, are we to the point where these guys are now exiting to the next stage? Like, all right, this is happening. Is a reset coming? It almost, whether planned or market induced, I'm having a hard time seeing another outcome. So I'm curious what you think about that.
Again, that's for Andy.
Yeah, hey, no problem. And I think, I mean, look, I think I have to first of all compliment you, Chris, on your amazing episode. And I think people don't understand how much effort and energy went into that.
I wasn't in someone's parking garage on this one.
No, we don't want that one. I think that people were questioning your sanity on that one. But anyway, no, you did an amazing one, which was here's how the bullion banks rigged the silver price. That was that episode. I honestly suggest people look at that more than once. And I think to me, that was just the next chapter of your big silver short book. And I think so people should thank you for that, because what it says is we're talking about the same things here, because what you're trying to address here is how people have lost through these waterfall events, how everyday people have lost their money, and perhaps even suggesting ways of addressing it. So I really recommend it, but essentially what it did, essentially what you were doing was discrediting this claptrap. It's a nice word because I could use something much worse than that, coming from the industry apologists like Jeffrey Christian, Jeff Curry, talking their own book. Now, it's amusing how they popped up just when the Reddit silver squeeze got mainstream media attention. That is the time they popped up. I mean, what a joke. I mean, after all the evidence, including JP Morgan being labeled a criminal enterprise by the DOJ, Christian is still trying to spin there is no gold or silver market manipulation. And the trouble with guys like Christian, they seek to hide from these big players just how leveraged and dislocated the paper markets have become from real supply-demand fundamentals. Now, this way, they can sell their snake oil. And it's the classic hurt and rescue, if you think about it. You've been in the options market, you know how these things work. It's the hurt and rescue. You sell expensive hedging strategies that would be completely unnecessary in a market unpolluted by paper market manipulation. And as far as Jeff Curry is concerned, over the years, it has blown my mind. He pops up every now and again when there's a bit of an emergency, if gold's looking to break out, and calling gold down to $800 or something crazy.
You've heard Jeff Curry talk about gold or silver before last February?
Oh yeah, not silver. No, never.
You heard him
Always
talk about gold?
gold, yeah.
Can you, after we're done, I'll make a note. I'd love to hear his commentary. I've never heard of him before. I'll tell you what, his appearance sure looks different over the years, which is a little unusual. But Andrew, you mentioned Jeff Christian hiding things,
Yeah.
and it came out wrong. I'm sorry, or maybe it didn't. I'd like to pull this up. I was only 2 years old in 1980. That's why I'm excited to be reading Jerome Smith. I keep confusing him with Harry Brown, who I can't wait to get into his next. But I'm wondering if you can confirm this. I'm going to read the whole page here, if you can bear with me. But this is describing why silver, what happened in 1980. We'll just leave it at that. Obviously, the exchange officials would have to use heavier weapons to drive the hunts out of their massive holdings of long futures contracts. So on the morning of October 25th, the Chicago Board of Trade Board of Directors invoked their temporary emergency powers, despite there being no emergency, and adopted a self-serving rule setting a limit of 600 silver future contracts per account. Sounds kind of like Robin Hood. Maybe they were reading this book too. Prior to this, anyone could go long or short as many silver contracts as he desired or could afford. The COMEX and CBOT boards were by then obviously determined to make whatever rules were necessary to cause the longs, the outsiders, to let go and prevent a squeeze on the shorts, the insiders themselves, who a page before he mentioned several of the COMEX executives. Andrew, if you know Dr. Jarecki of Scotia Makata, I'd love to hear more about him in a moment. Since the margin raises decreed by the exchange boards had all but shut out the small speculators, the open interest on the short side of the two-way trade gradually congested into the thin ranks of the bullion dealers. This occurred by the third week of 1979, and here we'll read from Paul Sarnoff's Silver Bulls. On Monday, November 26, spot price rose by 8.5 cents to 16.40. Open interest was 9,500 contracts. Delivery of all the involved silver would have required 7.8 billion. By the 28th, 2 days later, goes up $1.46 to 18.26. We have 7,500 contracts. And I'll skip ahead to the next paragraph. With a total open interest of 11.5 million ounces, when there were 55 million ounces in the COMEX board had been told back in September, you don't have a problem. But evidently some of the board members did. They lost plenty of money on overhedged or naked short positions as the December holders of the longs profited. By early December, practically the entire March 80 open interest on the short side appeared to be held by bullion dealers, including Makata Metals, which would be Dr. Jarecki, J. Aron, Phillips, and Sharps Pixley. Eric or Andrew, can you confirm that Jerome Smith is accurate here, that J. Aron, the firm that Jeff Christian brags about being associated with, and then says that anyone who talks about there being a big short position is a conspiracy theory Fruit Loop? Can you confirm that he is direct lying because his own firm was one of the biggest shorts? Is that accurate?
Well, I'll say this. This happened a couple of years before my time, and we all know the story of the Hunt brothers, how they were forced to cash settle. But look, I don't have any direct knowledge whether J. Aron, aka Goldman Sachs, was the ones with a large short position at that time. But it certainly wouldn't surprise me, because at that time there were only a few handful of players that could handle that kind of positions. And even the Makatas, these were before they hooked up with bigger entities like Scotiabank, right? So they weren't even that well capitalized. They were long-term, Makata had been around since, I don't know, 1700s or whatever it was, but and Sharps Pickley, the same thing. But they weren't nearly as well capitalized as J. Aron, because J. Aron had Goldman Sachs behind them. And that element would suggest that it doesn't surprise me that they were able to have that large a short position, but I don't have any direct knowledge.
Andrew? No, I don't personally know about that, exactly how that came about. But I do think, we do connect the dots to Christian and J. Aron. And I think that this kind of I mean, we're talking about basically the Hunt brothers. Essentially, as we're talking about, the Hunt brothers said, what have they done? Is, of course, borrowed money from the casino, and huge mistake, and got wiped out. And I think obviously, there's only one way to address that in the future. And I think this is lesson learned. Where does this bring us to today? Well, interim, what it does is bring an awareness to the market that wasn't there before. And so if we just say in Christian, when he, in the March 2010 CFTC meeting, and I think you played a great little clip of it recently, he made a massive mistake in trying. Now, bear in mind, he's an industry apologist, and so he has always been so, and he claims to be so. But what he did was made a massive mistake by saying we're trying to spin that 100-to-1 paper gold leverage was acceptable. This was a massive backfire. What it did, essentially, I mean, bearing in mind, I think it actually really pissed off the industry, because that was something that we knew, and in fact, the Reserve Bank of India in their 2010 report mentioned 92-to-1, but I think that flew under the radar. Most people didn't ever look at that. So, but he was tricked into, because I was talking to Bart Chilton through this meeting that was 6 hours long. We were asking questions like, is each ounce to HSBC, is each ounce backed by an ounce of physical that you're trading? And it was he then jumped in to say, well, of course not. And I think this really backfired, because what happened, he then tried to disparage everyone who's ever said that there's been any form, whether Gatter, Bill Murphy, Ted Butler, me, everyone else. And I think this was not a coincidence. And the reason I mention this was not a coincidence that gold rose $800 right after that meeting. What happened was within hours of that meeting, I was getting phone calls from Asia, from people saying, are you kidding me? I mean, you've been saying like 99, 100-to-1, whatever, silver 500-to-1. But directly after this admission, we saw the price rise. So that kind of brings us to today, which is, okay, so now we have a potential Hunt brother type setup, except it's going to be physically driven. And I think this is the beauty of this Wall Street silver squeeze. It's the beauty of the Reddit group. What they're doing is saying, well, hold on a minute. If we go after silver, let's go after physical silver. Let's own it. And then essentially, if enough of us keep buying this, it's a relentless pressure on these shorts to say, hold on a minute, we can't do anything about them. They didn't borrow anything from us. And that's why I say, even if you're looking to take bullion off the COMEX, and you're big enough to do so, even though you're going to run into threats from UBS and all of the group, you'd have to be a disruptor to do it in any size. But there are disruptors around. I've been speaking to two already who could potentially, and the position limits, by the way, suddenly move up from 1,500 lots to 3,000 lots within a day or so of Scotia Mocatta exiting that little cartel on the COMEX, even though they're still market makers in London. So you've got this kind of setup now where, and I think this is why it's important, we talk about history, but we talk about the lessons we've learned. We learned and how we've all been educated along the way, and how everyone in the market now understands, yeah, there's this leverage, but how do we get rid of it? Well, here's the solution. I think silver is, of course, the Achilles heel. You've already said it, you've written books about it. We all know it's the Achilles heel. And I think what really, really is exciting me, Chris, is the fact that this is underway now. And this is a really interesting time.
Yeah, and we will dig into that, especially with a Fed meeting. I think we're only about 3 hours away from the announcement. I have that right? My clock, think it's about. And sometimes they do it at noon, sometimes 2:15. Someone will know. Although one last thought before we move on to what you might be expecting there. I just thought this was interesting because the date of this meeting where he talks about, and people, if you want to hear what Jeff said, you can, OTC sells gold it does not have. This was posted 27th. The meeting was actually the 25th. And Andrew, I pulled up as we were talking. Look at the rally. There's the 25th, right below 1100 after Jeff's done. And then you take a look at the yearly chart. Maybe we should get him at a Fed meeting as well. Could be fun. Okay. But what are you guys expecting today? It's interesting. Here's the cover of CNBC, getting the top issues going on between, I mean, what's really vexing the market is whether Amazon or Walmart sells more stuff for printed money. Tiger Woods is home. Although, because I follow silly things like the bond market, 10-year treasury yield hits fresh 13-month high of 1.66%. Let's take a look at where it is now. 1.68%. God. It seems to me as if the bond market is front running the Fed this time, as if people are finally wising up to what's going on. Eric, would you like to comment on the Fed meeting today first? What are we close to seeing this really get out of control if it's not already happened?
I don't know. I'll let Andy speak. My feeling is they're going to try to control it as much as they can, to phase it as much as they can. But against a groundswell of data that would suggest otherwise, it's going to be difficult for them. But I still expect them to be able to, creatively manage it, whether in real terms or in PR terms or in kind of the fake financial elements that they can input into the whole equation.
Andrew, how do you expect they will manage that gold and silver? They're stuffing those down because anyone with common sense is buying them. And now bond yields are shooting up. The CNBC says people are worried that Jerome Powell is going to raise interest rates later this year. I'm thinking, really? What planet are they from?
Yeah, really.
So my interpretation is that people are leaving the bond market because of all the money printing. And the only thing the Fed can do is say that they're going to print more money to try and rig it further. How do you see this one shaken out?
I think this is one of the primary reasons we've seen underperformance of gold and silver over the last 4 weeks. I think we've got this toxic cocktail of stronger dollar, higher bond yields, and it's really been the driver of this automated algo selling, mindless automated algo selling, which completely misses the fact there is a physical market ultimately underpinning this, even though with the massive leverage. And I think so really today, I mean, what's he going to do? He's already told the market no yield curve control. He said that 2 weeks ago or whatever it was. So I think nobody's expecting that. And so because there's no hopium of that at this point, especially if the stock market's not collapsed at this point. I mean, I think if the stock market was looking really weak, we might get some sort of trial balloon of that. But I think now, nothing. I think it's going to be a non-event. I think that gold and silver you've got the usual volatility, the usual rubbish that goes on before, the obligatory volatility before any Fed event. But I think gold and silver, because of this algo selling that we've talked about, which is mindless, what it's done is driven gold and silver into a deeply, deeply massively backwardated condition. We saw $5.90 backwardations at one point in gold to spot. We've seen the silver market actually morph for the first time since March 2020 into a forward to spot backwardation. Now that is extremely unusual. I mean, we're not talking about futures to spot. We're talking about forward to spot. And what that did was one of the reasons we saw a big outflow of SLV, because because then as a money manager, you're going, hey, holy smoke, I can actually make money if I take my unallocated silver, actually take unallocated silver, and then I then can, not only can I make a profit on that, but I can actually park some money in the money markets as well, and I can make a return. Now that only lasted a few days, and then I think the other thing we saw was SLV. The outflows were really actually the banks coming in and literally borrowing silver to smack it down. And so, yeah, so as far as the Fed's goes today, it's baked in already, non-event rally because of a deeply oversold market.
Andrew, I think they're going to have to call the Exchange Stabilization Fund early, make sure they're back from lunch, because as I sift through these, it's been quite a trip recently thinking about my childhood, how I used to believe this stuff. Would you guys believe I was completely intimidated? I thought all the guys on Wall Street were smarter than me. Then one day I wake up and read things like from Bank of America, Powell will have to strike the right balance between an optimistic economic outlook. So, right off the bat, he's going to have to lie, and the Fed's willingness to allow inflation to run hotter, just a touch hotter than usual, in an effort to make sure that fraudulent employment statistics can be juiced and include all income, race, and gender. Because I don't know if you noticed, the Fed now has included global warming on its mandate. I mean, it's amazing. They're gonna decipher which policy dots are moving towards rate hikes. What rate hikes? These guys haven't. They told Bernanke that was 15 years ago. He told us they were going to hike rates. So what do you think is going to happen? I mean, my guess, Andrew, is maybe they'll follow, in fact, what you emailed to Elliot Ramirez of the CFTC when they ignored that evidence 11 years ago now to pave the way for future commissioners to ignore future evidence. But you mentioned, and we've seen this on the charts, especially, let me pull up yesterday's, because you described, and Eric, you could comment on this as well, how often if there's good news for gold or silver, they'll let the price run up first. So you get a couple more people on there before they screw their customers as those court documents released. What do you think will happen today on when they release the whatever Fed? Are they going to hammer it down, or is it going to lose control, or what do you think, fellas?
Well, look at the chart behind me. It's exactly what you're saying. It's actually, that's exactly what's going on, isn't it? And so, I mean, I think the market's conditioned, and this is part of the game, isn't it? It's part of the paper game. It's like condition, psyop people, condition them to think, well, maybe I just won't buy anything until after the Fed. Even though I know it's good value. So, and that, of course, what we're seeing here, look, if we go back to the structure of the market right now, here and now, and it's even evident in this ridiculously delayed COT report, every insider is long gold and silver, and it's only the specs who are either on the sidelines or short, wrong-footed short, because they've been chart painted into believing that this is going to go down. So all you have to do as an insider is pull some bids. You don't have to go short. Just pull a few bids, keep capping it. Other people are on the sidelines saying, well, hey, I'm conditioned to this market. So, and being part of the problem essentially, but not really, because ultimately what happens is that when the price comes down, as it is now ahead of the meeting, well, it creates a huge buying point. So, but these guys are not on the short side at all. They're taking the long side of every idiot who is selling into what is a crazy, crazy situation. And so, yeah, I actually personally think that it's going to be a non-event, completely a non-event, and that this is a major buy point.
I agree. And Eric, I got one for you here. This is yesterday's gold chart. And Andrew, you just mentioned how a market maker, if they pulled a bid, reminds me of what I was thinking yesterday. Again, I've been a market maker. And if you have a lot of buying pressure, which I think we do, let's say they just pulled their offer. Let's say the offer was at 17.35 and they decide, you know what, I'm just gonna pull it $5, let it go up here, and then drop the hammer. Was that a spoof, Eric?
I couldn't say whether that it certainly could be, but you know, I couldn't say. I wouldn't want to say definitively that it is, but they have the ability to do that. That's for sure.
All right. Do you have any thoughts? We see this pattern a lot where here, you know, there's often increased volume and we see these wild swings. Any thought or comment on what's happening on those?
I can comment. I can comment.
All
I
right.
think you referred to the Elias Ramirez. When I was sitting working side by side with the CFTC, explaining to them what a spoof was, and giving them the terminology that they said, well, what do you mean by spoof? You know, et cetera, how it works, how the options guys. And you know this more than anyone because you understand options implicitly, is how you can then target an option structure and force, in other words, if somebody sold a put, obviously, you can force them to delta hedge and literally sell futures to actually keep that position delta hedged. And so that would be part of the strategy: pull some bids, force a massive option smack, take the long side of everything, rinse it back up again. That's probably what you're looking at there. I mean, to me, that's really what this is how the game works. So has it changed? Well, no, we sat side by side with them and said, hey, why don't you pull this ticket? Look, here it comes, pull this ticket. And then, you know, time after time, we even went into granular detail with them. And it's taken, I mean, how many years? I mean, that was 1989. Basically, well, sorry, 1990. So basically, what we're looking at here is probably the same kind of thing, but just a little more sneakily done, because you know, obviously the regulators are definitely watching the market, but I think also we have to factor in that there is, and although silver is just a fellow traveler of this, officials, central bankers are definitely managing the gold market, and they don't want it revalued yet. So what they're doing is, obviously, this is why you can get away with, where you see these kind of charts you're putting up, and you think, oh, holy, look, hang on, that was way in excess of any position limits, even though they've just increased position limits on silver from 1,500 to 3,000 lots because of liquidity drying up in the COMEX, and you need to keep the guys bolstered, because if you've suddenly got Scotia exiting as a market maker on the COMEX, hang on a minute, you better try and find some liquidity somewhere else, so give everyone else a few more chips to play the game. And I think that's what's going on. So, but I think it's essentially, I think this game, we can talk about it all day, but I think this game is done. And I think it's done because there's a physical buyer coming in, and the physical buyer is a group of people buying physical. And there's some whales in there, some big money coming in there. But I also wanted to mention that there is two disruptors that we're speaking to who have the wherewithal to take delivery of silver in the market, and it'll do the job. It'll actually do the job. Can you imagine 3,000, just even if one entity stood for 3,000 lots of silver, what, 470 tons or whatever that is? Can you imagine? That's not deliverable. Nobody is going to deliver that, or wants to deliver it at $26. No one's going to want to deliver. That's crazy. Everyone understands silver's worth at least $10 higher than here. I mean, and that's why the insiders are all going along on the COT report. So it's really interesting because we've never seen this dynamic before, and I think the game is just about done.
Can either of you offer a guess on how much silver is out there? Let's say that a lot of people bought silver. How much could be filled? Is there 100 million ounces? Is there 200 million ounces? What is if, let's say everybody on the planet bought 5 ounces of silver tomorrow? Is there any gauge of how much is there before we reach a break point and something has to be cash settled?
I think the answer is every single ounce is there at the right price. So it's really a question of, the offer rising enough for somebody to willing to sell and fill that order. And I think that's the problem. And we kind of psyoped into thinking that, well, there can only be one price, and it's the paper price, but not if people actually are taking physical delivery, and that physical delivery has to be delivered. It has to. So therefore, there comes a point where the price the offer has to come up to a point where somebody is actually willing to say, oh, okay, I'll sell some here. Oh, hang on, it's rising. Maybe I'll raise my offer a little bit more. And you will eventually come up to an equilibrium price. My God, what we're talking about is a fair and even market.
Eric?
Yeah, and I'll just say that, look, if you come in your own mind of what the real leverage is within the silver market, and whether you think it's 100 or 500 to 1, based on that metric, you can back into a number on the physical side that would suggest you can make a tipping point with a relatively small amount to make that deleverage happen. It's one of those things where if it happens, and let's just say when it happens, let's be proactive about it. When it happens, it's gonna have a waterfall effect that will be much larger than that initial break. It'll have a big add-on factor that will just steamroll.
I certainly agree. That's why I wrote the book, and what I can't see how else. I mean, if someone tells me it's going to take longer than I think. But again, is there any, I know it's not an easy question to put a number on, but are there any metrics that you look at in particular to gauge how close we're getting there, or anything that people would want to, at home, might want to keep an eye on for their own research?
Well, for me, it's a little difficult because of the varied way that now people are taking the physical, and some of it is in non-traditional ways, stacking from different sources, and that takes time to take itself out of the official pool of physical. So it's hard for me to gauge what that, you can kind of see the groundswell, you can see the focus, and the group could be large that's doing it. It's hard for me to gauge what that actual physical number is that's being able to be tapped into, because it's coming from many different sources that are relatively, the data on it and the transparency on it is relatively scarce, and that I'm aware of. But Andy,
That is certainly. I'm sorry. Go ahead.
No, I was going to say, I mean, and I think it's, I mean, for example, I mean, I think you sent me something about Perth Mint a minute ago, and we could talk about that if you want. But the thing is that these silver, especially silver in particular, is difficult to get in certain jurisdictions and less difficult to get in others. So, and obviously then there's all the transport costs, et cetera, that, and premiums, even if you're having to pay, a buck over, which is ridiculous for a wholesale bar. But the point is it's available, but it's only available, and we find it available a little more easily because we have, we've got 12 volts that we can source stuff from. But it's actually very, very difficult to gauge, because if you looked at the Perth Mint right now, you'd say there is no silver in the world left. And I don't know if you want to talk about Perth Mint, because you sent me something from Wall Street Silver, which looks pretty wild.
Yeah, in fact, I was just going to say, I don't want to keep you guys too long. I have a couple of great questions left. We can do quicker, but yeah, if you have time, that would be great. Let's see if we can get that pulled up, because here is the message. Well, give me a second. I'll track that one down. Although while I do, perhaps you can see they did have an announcement saying important notice, no silver shortage at Perth Mint. I mean, they're making some announcements, increasing experience demand. But if either of you guys are a little bit more well-versed on what's going on there, let me know what you're hearing.
So this is their response, right? So it came across the wires that they're having trouble fulfilling the demand. And then there was a lot of posts within the different social media platforms of, see, you know, it's starting. And then this is just their way of covering themselves by saying, no, wait a second, there's no shortage. But what they mean is that shortage is a relative term because it depends on the timing. So you can say there's no shortage, but if it takes 3 weeks or a month or more to actually get it, you know, you could argue, yeah, of course there's a shortage. So I'll let Andy talk about the bigger picture of it, but it's clear to me that there is, you know, and it's not surprising that they're having an issue fulfilling demand, and that there are timing issues of being, because there's just not a whole lot of physical silver to be had in very traditional venues. Well, Andy, you can chime in on that probably in a bigger picture way.
Well, yeah, from a wholesale market perspective, I mean, you know, even going out as far as Russia to buy physical, you know, you've got COMEX companies going in there, just hunting physical all over the globe. So what used to be an exclusive, now everyone is all over any supply of silver, wholesale silver, where it comes from. So what that does is reduce the amount for each person. So in other words, somebody comes in, how you just determine from a refinery how much you're getting, and you come in and you say, I will commit to between X and Y per year, sign it, and it's a done deal. So you will never take less than, you'll never be given less than, and you'll never be getting more than. And then suddenly all of these agreements have been rewritten because people are coming in and paying huge premiums. And that's even a premium. On top of that is the cost for moving this stuff into the COMEX. So you're talking about massive premiums by the time all the transportation is done. So what we're saying is the wholesale market is clearly tight, so definitely tight. Then I would go on to, well, what's happening on the ground, especially US centric or anyone else, even in this country. I mean, if I want to go out and buy a silver Britannia, it's not available, but, oh, I think I saw the other day, £48 for the one that is available. Now, okay, I don't know where your prices are in the US, but I mean, they must be in the 30s. Is that somewhere around that? If you want an ounce coin.
Seems like the lowest premium right now. I asked Andy Sheckman last week. I think there's, I forget which coin it was, but it was about like 420 over one of the generic ones.
Okay, so you're still talking about 420 over. But I guess the point I'm trying to make here is that the average person who's not in the wholesale market, who's not connected like we are, who is some person sitting on Wall Street silver saying, I want to stack silver. What is the price of silver for him? It's spot plus 490. That they don't think of anything. That's the price of a silver coin. So you get enough people just looking at that and saying, well, that's the price of the coin. Then what happens is you're actually now fueling the wholesale market to say, well, hang on, guys, we better up our bids to get more physical. And maybe that then ultimately feeds into the COMEX, and ultimately people then come in and say, okay, I'm not big enough to worry about UBS threatening me. I'll just take delivery. Or you may be a disruptor, and this is what I'm hoping for, a disruptor who cares not whether they try and strike him off. If he owns the contracts and they default and call a force majeure on the fact that he wants to take delivery of 3,000 contracts or 400 and something, nearly 500 tons, then what's that going to do? That is going to create another Hunt Brothers kind of situation where everyone and their brother, sharks will swim. Even if they say, we'll cash settle you, it doesn't matter. Once the minute you've done that, then what you've done is create a frenzy of people coming in and saying, hey, it's so clear that they don't have silver at this price, that they will not allow their silver to be sold at this price. Therefore, let's all go and buy it. And that would be the end. That would be what you'd have then is you'd have you'd have the industrials coming in and saying, whoa, not just in time anymore, guys. We better go and get some tonnage. You know, I can't afford to stop the assembly line at Samsung or anyone else. I just can't afford to do it. So why would I care? I'll just go out and buy it. I mean, so what? The amount of silver I use in each phone, for example, what is that going to cost me? It's not going to cost me a tiny bit more to pay a higher price. So really, I think all in all, we've got a lovely cocktail of things going on here that is, and I think right from the wholesale market being definitely tight to the fact is that the average person now is conditioned to pay over spot for it. That is the price.
Yeah, and you can see here, it's interesting. In stock, 178 products. Out of stock, 3,854. I don't know if that's normally like that, but just a quick scroll through. We're looking at 2601 spot price. Here's those it was the Buffalo rounds. They have them $4.80 over. Eagles are $11 over. But if you scroll down a little bit, you can see, you know, a lot of stuff is out of stock. And, you know, so we'll keep an eye on it, shall we say. Although, Eric, you mentioned something before, in terms of how many claims there are for each ounce of silver. Would either of you care to venture a guess on that one?
Well, I've talked with Andy about it many times, and we've delved into it as best we can. And you know, for me, when I look at the numbers, it's, you know, you're talking about the leverage. It's anywhere from 300 to 500. It's pretty massive.
Yeah.
Jeffrey Christian actually came out, maybe it was 2 years ago, 3 years ago, in his silver report, and it clearly said 500 to 1 in that report.
It's conspiracy theory, buddy. Conspiracy theory. You took your flying saucer to the office again today. Again, I'm trying to get us wrapped up here. I got 3 more. What do you guys think about how about 25 million ounces have left the COMEX now, according to their reports? That we're now seeing metal leaving the building. And Eric, I know you've been around doing this for a while, both of you, but have we ever seen anywhere near this much leave?
Not that I haven't. No, that's a big number, and it's you know, there's a lot of elements that can go into that behind the scenes. There's a lot of these financial instruments that could be impacted and built into that. But no, I've never seen that much personally.
Yeah, Andrew, and do you have a latest count of how much is actually left?
Well, there's 10. Look, there's what has been stopped for March is around 10,100 contracts or thereabouts. Mm-hmm. That doesn't have to be fully delivered anyway until the 31st. So it is interesting because this is even the largest month of December was only 9,000. I mean, it was like 150 tons less than we are already seen stocked on the COMEX. This is, whereas we're looking at, if you look at January and February, and I can't remember the numbers, but you're talking about the teens. You're talking about, I think, I don't know if you've got the numbers there in front of you, but basically we're talking about nothing being stocked and delivered. So this is really unusual. And December is, of course, supposed to be the biggest delivery month of the year. And now we're seeing March much larger than that. So yeah, I tell you, there's something on fire here.
Well, I agree. One last question, Eric, perhaps, again, I appreciate you being here. I'd love to get your take on this. We touched on it a little bit we hear a lot of guys say that, well, there's this big short position that shows up, of like 300 million ounces on the COT report, but they claim that as a hedge. Do you agree that that's a hedge? And also, if it is, wouldn't that mean that somewhere somebody is short something, if it's not the banks? But any thoughts on that?
I haven't looked at that in a while, but certainly there is, look, there is a lot of wiggle room in what you can define as a hedge or not. It's not as clear cut as it's supposed to be, or as one would think. There are ways to say that it's a hedge, and somewhat legitimately, but you have some things behind the scenes that are clearly not a straight hedge. And so it's hard for me to, I haven't delved in it in a long time. I wouldn't be able to say whether there's a large percentage of that that is, kind of quasi hedging or not. So I don't know whether there's a big element. There's certainly some of that is very much quasi hedging, but I couldn't say, because I haven't looked at it in detail of what percentage might be, but it certainly is a big number.
Yeah, that's fair enough. And I'll just mention that coincidentally, it got a lot bigger, the short position, in the first week of February. Since then, as you can see the evidence of the banks covering their short positions as they spoof people out of their contracts to very deceptively commit fraud. The number has come back down. So anyway, last question. This one is for you, Andrew. I know I got a couple requests. You had, I don't know if you know Mario from London, who has a YouTube channel. I guess he's not fond of your interpretation of Basel III. And A, have you seen that? And B, if there's any comment you'd like to offer, and I'll let you take it from there.
Yeah, sure. We're all on the same side of the table here. I think we're talking about semantics here. Look, I think the question is the treatment of gold under Basel III going to be good or bad for gold? I mean, that's the bottom line of it. The rest of it is all just basically discussion. So, but basically what's happening here as of June 28th, and there's no dispute, and there's plenty of documentation out there that attests to the fact that Switzerland, Europe, US, and many other jurisdictions are going to accept Basel III rules by June 28th. So allocated physical gold is going to, at that point, receive a 0% risk weight. There's no dispute. Now that will apply to gold bullion held in a bank or held in another bank on an allocated basis. Now that is a change. And what it means, though, is that unallocated gold, if it continues to be utilized as a funding source for gold leases, accommodating that sort of a massive onerous financing conditions is what's it going to do is lead to a massive increase in leasing costs. So my concern is, look, I see gold as personally, and everyone I speak to sees gold as a first-tier asset. Now, on the semantic side of the hogwash of the smoke and mirrors world of the BIS, oh, technically it's not because it's also a currency. Yeah, well, gold is a currency. Yes, it is. It's a foreign exchange, which is unlike pretty much anything else. So basically, what this does, though, it raises a massive issue for the paper market. I see this as really positive for the price of physical gold and very bad for the markets. Now, look, basically anticipating we're going to get maybe a question, I pulled up the LBMA's, I think it's March, just a few days ago. Implications, it says, this is what tells me that these guys are on the back foot, and this is going to be massively bullish for gold. The LBMA says, should an 85 RSF requirement be required, we may see one of three things. These are the three things: a rise in the cost of clearing and settlement service provided by the LPMCL, which may impact the service. Oh my goodness, really? A fall in market liquidity as banks look to exit the market? Yeah. And a rise in the cost of doing business across the supply chain. Well, what is this telling us? What it's telling, I'm not going to go into all the detail here, but and then they go on and on and on about it being such an awful thing. Well, bottom line, out of the 8,000 tons, this is the bottom line question. Out of the 8,000 tons of gold cleared every single day through by the LPMCL, how much do you actually think has got anything to do with real bullion banking business, like providing services to producers, refiners, etc.? It is a tiny fraction of that. So the point I'm trying to make, and this is the most important point, is this is going to severely impact the ability for even central banks to lease. And we were talking about earlier, Eric was talking about the various layers and how these leases continue to get leased up through sub-custodians, et cetera, et cetera. What it's going to do is make those too expensive. And so, yes, this could actually raise the cost of doing business for producers, et cetera, who need financing. But that's only going to raise the price of the product. So it's not going to cause an issue. It's not going to cause a problem. So really, what we're seeing here is an inflection point where we see a revaluation coming. It is inevitable. Every central bank that look, you can even look, all central banks are buying, repatriating or buying gold. Why? Because of exactly this reason, where you now can use your gold effectively as a tier one asset, even if the semantics say, well, it's 0% risk weighting. Never mind. This is still a major bullish input, and we could do it. Look, we can go into a lot more detail, and we could do this at any time you want, Chris. So just to address these, there is no pissing match here. Yeah, we're all saying the same thing. Ultimately, it's going to be good for gold.
Yeah, and I think, even more than those individual details, that you bring the bigger point that it's stuff that is intentionally designed so that it's not clear. So yeah, maybe we have different interpretations of how these things go, but I don't know. I think everybody's on the same team here, and hopefully we can get back to swinging away at the government piñata together, which is really getting a lot more fun. And hopefully, I think over the next couple of hours, we'll be able to get some good candy out of the Fed. So guys, I can't thank you enough for making some time. I know we went a while today, but before we wrap up, any last thoughts you'd like to share? And I'll also pull up the Kinesis website if you have some updates there that people should know about.
Well, I think what's interesting. Yeah, sorry. I was just going to say, did you see what we were doing with Wall Street Silver? I think,
I saw that you're giving away some silver there.
Yeah. Eric, do you want to talk about it? Or?
Well, we just very briefly. So it just goes to show we have silver to give. So this is one of the important things that, when you see these little pockets of demand issues coming up from something like the Perth Mint, saying that no, they're saying they don't have a shortage, but really they do, because it's a timing. They won't be able to fulfill the demand. And you see JM Bullion saying that they're out of stock on thousands of different products. This is where something like Kinesis and ABX underneath brings a lot of value to what this groundswell effort is looking to do, and it's because we don't rely on one mint like the Perth Mint. Of course, we utilize any LBMA bullion, but because of our geographic location of the 12 vaults, because of our suppliers from multiple dealers, and because of our market makers underneath Bullion Capital and other liquidity providers on our market, we have physical supply. We have a lot of it, and it's because we aggregate it together from geographically and different suppliers. And I think that's an important distinction when you see these spikes of limited supply in certain areas. When you're able to aggregate over multiple dealers and multiple locations, that kind of falls away. And so we have a lot of physical silver available to us, and and going through this groundswell through the Wall Street squeeze guys and whatnot is it's right in our wheelhouse.
And Andrew, any other thoughts or updates we should know about with Kinesis right now?
Well, yeah, I hope that I see that we've had, not only did we give 25,000, 1,000 ounces of silver basically to spend on advertising at Wall Street Silver, but we also opened up 1,000 ounces to every member there, free to just literally create your account, log in. I think right now, they told me it was 937 people had already taken those ounces. There's still a few left, guys. Go and sign up and get your free ounce of silver, and you can put it in your wallet, and there it is. And bearing in mind, the other thing to remember is that Kinesis provides all the security to trust your silver is always titled and accessible to you. And so really, it just enables you to exchange your currency for any other currency, and to actually use it and earn a yield as well through it. But go on the website, have a look, see how it works. I mean, I know that we're getting a lot of signups from these guys.
Well, I'm glad to hear that. Did you have something to say, Eric?
No, yeah, like I said, it's almost, as Andy said, it's about 1,000 accounts now that have signed up on the back of this, and I'm sure it'll be quite a bit more before we're finished. So yeah, it's all good stuff, and it is direct title of the underlying. It's in your name. It's not in Kinesis' name. It's not an ABX name. It's the title to the billion is yours. It's just in a digital format.
Yeah, well, that sounds a lot better than owning SLV shares. So, gentlemen, I know you're getting excited for the Fed meeting. I'll wrap up here for today, but certainly thank you for making some time and being here. One final note before we wrap up: special thanks to Silver Sands, who has brought us today's episode as they advance their high-grade Virginia silver project. So just want to make a quick mention, thanking Keith Anderson for bringing us this great conversation in the silver market. Eric, great to have you on here. I'll hope to do this again. And Andrew, who knows, maybe the world will laugh at Jerome Powell's silly testimony later today. I don't even know if there's a press conference. I'll watch that one if I can. And
yeah, me too. Yeah.
We might have to do a new call tomorrow, depending on how this one shakes out, but it'll be fun to watch.
Yeah,
it'll be fun. Thanks very much, Chris. Appreciate it.
All right. And thank you, everyone watching at home. We will be back in about an hour with Michael Oliver, technical analyst digging into silver. So thanks again for being here. Hit that subscribe button, the notification bell, and I will see you again.